Good morning to this week's Q&A. We have a question this week from one of our viewers in Hong Kong, and it's relating to the regulatory or APRA buffer that's applied when banks do serviceability calculations for both existing clients who are looking to refinance their usually fixed rate loans or new customers in general. And there has been some talk in the media for a little time now that there is pressure building to ask the regulators to drop the amount of buffer that banks need to include in their serviceability calculations, which currently runs at 3%. So it's now getting to the stage where banks are assessing these people at nearly 10% to see if they can service their loans. And that's obviously a pretty big number. Now, very, very timely question, I think, because just yesterday, one of the largest banks in Australia, Westpac, came out with a statement that it may look to actually reduce that serviceability buffer for certain clients who are looking to refinance if they can't do so at the normal nominal rate. Now, I think that's pretty good news for borrowers, certainly good news for a lot of people that potentially can't refinance, to continue, say, interest-only repayments on their loans, to reduce the actual quantum of their monthly payment, because obviously interest rates have increased so rapidly and so far that would be a welcome addition to a person's cash flow to enable them to sustain themselves during this period of higher rates, because as we all know, interest rates are cyclical and things do go up and down. So I think that's a really progressive move forward. And to our viewer asked the question, hopefully it portends perhaps a recalibration of some of these buffers that are put in place, which are really there to assist banks not to allow customers to borrow more than they can actually comfortably service. However, in this situation, when you have existing borrowers on the bank's books and they've already borrowed the money, then it would be foolish to try and not assist them to continue to make those repayments in a timely fashion, simply by changing the criteria somewhat and maintaining the status quo of their existing loan book, as it were. So look, great question. If things like this interest you, please subscribe to our YouTube channel and click like. And also, we'll be conducting our quarterly review on 31st of May or 30th of May if you happen to be in the US or other geographic regions around the world. So please join us for that if you want. Have a look, and we'll be going into a lot of the data that's relevant to the Australian residential property markets around the country, and also what's happening in the arena of bank finance and home loans. I'm Andrew Unterweger, and I'll see you at next week's Q&A.